Yeah, it's been a bumpy ride again so far this year, which is a little bit of a shame. We started off on good footing, but over the last couple of months, our market has given up most of those gains. A little bit like the Warriors so far this year. We've showed lots of promise early on, but just haven't been able to fire on all cylinders. And in the case of our listed index, the real headwind has been the change in expectation of where interest rate cuts are going to be coming, in terms of that timing. So the timing of those cuts feels like it's been pushed out a little bit further, and that's creating a headwind for our market, which has lots of companies that are sensitive to those interest rates, much more so than other markets around the world. So we expect that sort of choppiness to continue over the next few months. But I guess the thing to keep in mind is that we're in a really contractionary period where interest rates are high, and we don't expect them to stay there forever. So at some point over the next sort of 6 to 12 months, we expect to see some interest rate relief, and that'll be really positive for many of our companies which have faced those valuation headwinds as interest rates have stayed elevated. Plenty going on in our market at the moment, but if we stick to probably three key themes that I think are prevailing at the moment, the first one is just around inflation being a bit stickier than we expected. So we peaked in New Zealand at 7.3% inflation. We've come all the way back to 4% now, but the Reserve Bank target is to be somewhere between 1 and 3%. So 4% is great when you think about where we've come from, but it's certainly not to that midpoint of the Reserve Bank range. So the fly in the ointment really there has been domestic inflation, so what's termed non-tradable, and that's sticking persistently high. And if you think about your rates, your insurance, rents, all those things are in that basket of non-tradable because we can't trade them with someone else. So that's remaining quite sticky, and that's forcing the Reserve Bank to keep interest rates reasonably high. The second theme, as a result of those reasonably high interest rates, is that our economy is weakening. If you look at the GDP data that's been printed over the last little while, 4 out of the last 5 quarters, we've seen our GDP contract, which is not a great background for businesses, for consumers, for listed companies. All creates a lot of pressure. And the key thing there is we are seeing businesses struggle. We're seeing consumer spending fall. And while that's all typical when you have high interest rates, I guess the trick is not to let it go on for too long and really hurt the economy badly. And then finally, I guess the third dynamic, and I mentioned this at the very beginning around why our market's been a little bit choppy so far this year, is really that delayed interest rate cut expectation. So we were thinking, or the market was expecting interest rate cuts probably towards the middle of this year. It's probably been pushed out a little bit longer towards the end of the year at best, because that inflation is proving to be a little bit more sticky, which means the Reserve Bank has to keep interest rates high and keep that sort of tightening pressure on the economy to slow things down. The reality is the Reserve Bank won't be able to ignore the faltering economy forever, and it certainly doesn't want to end up in a position where, yes, it's solved the inflation problem, but it's created another problem in that our economy is in sort of dire need of help, and that would force big interest rate cuts. So it's that balancing act that the Reserve Bank really has to kind of get across over the next 6 months. Yeah, so our listed companies are pretty much telling us what we're seeing already in the macro data, that things are really tough out there. Consumer spending is slowing, and that means for companies that their earnings are slowing. So some of the big ones we've seen in the last little while is Air New Zealand came out and said that they expected a big earnings hit this year, and the key part of that was a slowdown in the domestic business. Tourism Holdings, which you'll think about the camper vans that are rented and driving around the country at any point in time, Tourism Holdings owns those. So even though they said the demand for those rentals is holding up reasonably well, particularly from offshore tourists coming here, the bit that's been difficult is selling rental camper vans. So think about 3 or 4 year old camper van. Tourism Holdings sells that onto the market, and they've had real trouble selling those at this point. Again, shows that consumers are tightening their belts. Some of those luxury purchases, like a camper van, are getting put to the side. So another sort of 30% earnings downgrade flagged by Tourism Holdings. Even Spark, this is a mobile operator which should be pretty defensive, and is, but they downgraded their earnings by about 5%. So not catastrophic by any means, but even at the fringes, a pretty stable and defensive business like telco is showing some signs of hurt from what's going on in the economy. And then finally, one that was probably of little surprise is the warehouse came out with their third quarter update, and again just saying growth is slowing, sales are slowing, their margins are contracting. It's all pretty tough out there for whether it's Noel Leeming, whether it's the red sheds of the warehouse, all the warehouse stationery business. So continued hard times for anyone in that retail sector at the moment. Yes, so May's actually quite an interesting period for us. We have a little mini reporting season, I suppose, of about 20, 25 companies that will release their results through the coming few weeks. So while there's a whole host of or a range of companies through there, there's 3 aged care companies, and that's a sector that's been under the microscope the last little while, including Ryman Healthcare. A number of our listed property companies will report their results through this period as well. Then you've got powerhouses like Main Freight, which is always interesting from a global perspective. You've got Fisher and Paykel Healthcare and Infratil. So some decent big size names that are coming out over the next couple of weeks, which we'll be watching for. Other than the company news, I suppose lots of macro data will still be coming out, whether it's migration numbers, whether it's retail card spending. On the 22nd of this month, we've got the Reserve Bank coming out with their decision for the official cash rate, so that'll be closely watched. And then the other big event this month is right at the end of it on the 30th. The current government will come out with their budget, and things have been pretty tough. There's been a lot of cost cutting we've seen from the government, so I expect that there's probably not going to be a lot of rosy good news, and it'll show that the government is tightening their belts as well. But that'll be something that many of us will be keeping a close eye on towards the end of this month.
For more insights, visit craigsip.com.